This is a real crisis. I mean, we've seen regional bank failures. That's just the start of it. The real.
You're watching Silver News Daily. Subscribe for more. Silver is about to hit $2,000 in the next 30 days, and it's a forecast that's sending shockwaves through the financial world. Imagine the potential gains if you act now. This isn't just a wild guess. It's a detailed prediction from Alisdair Macleods, a renowned expert in precious metals. In this video, we'll reveal exactly how he believes this explosive surge will happen. From the Federal Reserve's latest moves to geopolitical tensions and market dynamics, we'll break down all the factors driving this incredible forecast. Stay tuned to uncover the full story and prepare for what could be one of the biggest opportunities in the silver market.
Therefore, we should, why is it going up? Perhaps we should buy it, sort of thing. So it's a sort of in-between period, if you like, in terms of the psychology of markets in the West. The fascinating thing about it, however, is what are the Chinese actually doing? And if you look at it from the Chinese central bank's point of view, the People's Bank of China, they have a long-term policy of reducing their dependence on Western currencies. This, after all, was the whole point about trying to set up a new trade settlement currency for BRICS, which was mooted before the Johannesburg meeting in last August. It is also a vowed public policy of the Chinese government, the Saudis now, Russia, Iran, the Shanghai Cooperation Organization, and the extended BRICS organization as well. So what we're looking at a situation where the two major hegemons, particularly Russia, who's, with Putin had his nose put out of joint by sanctions, currency sanctions, and China, they basically want to do away or lessen their dependence on the dollar. So from the People's Bank's point of view, it would be entirely consistent for them to reduce their holdings in dollars. Now, when you look at that properly, really, it's not so much that they're buying gold, but it's more that they're selling dollars. Now, this adds, and I think that this is something which markets will begin to realize quite quickly, it adds another dimension to the dollar problem. And that is that the largest single identifiable buyer of US treasuries is the Chinese government. And the Chinese government is selling dollars. And if it's selling dollars, it's also selling the underlying assets in which those dollars are invested, which, of course, includes a figure like $775 billion worth of US Treasury debt. So if the Chinese are actually reducing their dollar holdings, then what that means is that they are not going to be participating in the increased financing requirements of the US Treasury with a budget deficit of over $3 trillion to fund. This is going to create a debt crisis for the US Treasury. So that message, I think, is gradually spreading in the higher echelons around Asia, particularly China, Russia. Russia, I think, can't wait, basically, to crash the whole thing. The only reason they don't do that is because of their relationship with China. But China can see that things are changing. They have got to change. I mean, the problem for China is that they really have no alternative but now to just quietly ease themselves out of dollars. And that is what they're doing. And of course, the other thing, there is increased speculation on the Shanghai Futures Exchange.
Silver prices have been on a roller coaster ride recently. Just last week, silver dropped to $30.46 per ounce, down over 1% from the day before. Despite this dip, silver prices have surged by nearly 20% since the beginning of the year. This volatility is nothing new for silver, a metal known for its sharp and sudden price movements. The recent drop came after hitting a high of $32.19, showing just how quickly the market can change. Investors are keenly watching these trends, looking for signs of the next big move. As we delve deeper into the factors at play, You'll see why experts like Alisdair Macleods are predicting a massive surge to $2,000 in just 30 days. But first, let's look at how the Federal Reserve's actions are impacting the market.
And the Communist Party introduced legislation appointing the People's Bank of China as being responsible for managing the acquisition of the nation's gold and silver stocks, reserves, whatever you like to call it. You may recall that from 1983, I mean, we were literally a year or two into the greatest bear market gold has ever seen. A bear market that came about because America had an intense propaganda campaign demonetizing gold and replacing it with the dollar in terms of everybody's reserves. So it was a process which worked very, very effectively, and it shook out an awful lot of physical gold. Over that period, there was also there were innovations in mining, which meant that mine output increased quite significantly globally. This is, and so you had a combination of hoarded gold and mine supply coming out on the market, and it was an easy environment for China to accumulate gold reserves. Remember also that when this legislation came in place, it was perfectly normal to think in terms of national reserves, if you like, as being 10% gold and the rest, currency, credit, whatever. So the 10% gold, if you like, was a sort of portfolio allocation, which, was like an insurance policy against all the rest. I ran the numbers through. Now, basically, the other thing that the People's Bank was doing, and you've got to remember that there were huge restrictions on what individuals could do. There were very strict exchange controls, for example, and the public were not permitted to acquire gold and silver themselves. Holding gold was illegal until 2002. So all the foreign exchange dealings, when you had inward investment as China opened up its economy to manufacturing, and then subsequently the continuation of those flows, and at the same time, the export trade was beginning to boom in, really from the early 1990s, right, or 93, 94. It really began to boom from then. If you looked at those flows and calculated the reinvestment of those flows into contemporary gold prices, which you may recall fell to as low as $250 an ounce in 1999 and I think 2002.
One of the most significant influences on silver prices in recent times has been the Federal Reserve's policies, particularly its hawkish stance on interest rates. When the Fed releases minutes suggesting rate hikes, it sends ripples through the financial markets, and precious metals like silver are no exception. In the latest instance, the Fed's hawkish minutes led to a substantial sell-off in silver, dropping its price by more than 3.5% after reaching a daily high of $32.19. This move was primarily driven by profit-taking, as traders anticipated tighter monetary policy could strengthen the dollar and push down precious metal prices. The relationship between silver prices and the Federal Reserve's policies is deeply intertwined. When the Fed raises interest rates, the opportunity cost of holding non-yielding assets like silver increases. Investors might prefer interest-bearing assets over precious metals, leading to a decline in silver prices. However, the recent dynamics are more complex. Despite the Fed's aggressive posture, silver has maintained an uptrend. This resilience suggests that other powerful factors are at play, bolstering silver's price despite the Fed's actions. Another critical aspect is the market's anticipation of future moves by the Fed. Even the hint of potential rate hikes can cause significant market adjustments. Traders often react not just to the actual changes, but to the expectations set by the Fed's communications. This forward-looking behavior means that silver prices can be highly sensitive to even minor changes in language or tone from the Fed. Moreover, the broader economic context in which these decisions are made plays a crucial role. The Fed's hawkish stance is typically a response to concerns about inflation. In times of high inflation, real interest rates, the nominal rates adjusted for inflation, might still be low or negative, making precious metals attractive as a hedge. This scenario can create a paradox where the Fed's actions, intended to curb inflation, simultaneously boost demand for inflation hedging assets like silver. Let's not forget the psychological impact of the Fed's decisions. When the Fed adopts a hawkish tone, it often signals confidence in the economy's strength, which can bolster investor sentiment across various asset classes. However, if this confidence wavers or if economic indicators suggest that higher rates could stifle growth, investors might seek the safety of precious metals, driving up silver prices. Additionally, the technical market setup can't be ignored. Prior to the Fed's latest minutes, silver had entered an overbought territory, as indicated by the Relative Strength Index, RSI. This technical condition often precedes a pullback, as we saw with the recent 3.5% drop. Yet this pullback is part of a larger trend where silver has shown remarkable resilience, suggesting that the underlying bullish sentiment remains strong. To understand why this resilience might persist, and why Alisdair Macleods' prediction of $2,000 silver in 30 days could materialize, we need to consider the broader economic and geopolitical landscape. Factors such as the Federal Reserve's policies are just one piece of the puzzle. As we continue, we'll delve into other crucial elements, like the gold-silver ratio, market dynamics, and geopolitical tensions, all of which could align to propel silver prices to unprecedented heights.
I think the People's Bank said it had something like 610 tons. That was it. The rest is secret. We have a similar situation in Russia. Russia lost all her gold, basically, before Putin came in. And since then, certainly the policy has changed. Russia has gone very anti-Western currencies. Very notably since sanctions. SWIFT was closed down to it and sanctions were imposed. And effectively, the West is stealing the credit reserves on the central bank's balance sheet. And that's subject still for today. But at the same time, Russia has been ramping up her gold production. She now produces over 300 tons a year. And I think she may just be third to Australia, but if it is, it's sort of level pegging, with plans to increase even further. I think one of the reasons that Russia has been concentrating on capturing politically the Sahel, which is that bit, if you like, between North Africa and the tropical Africa. Countries like Burkina Faso, Chad, Equatoria, Mali, and so on and so forth. Those are gold-rich areas. And I think that that's something which Russia rather wants to get under her control. The successors to the Wagner Corps, mercenaries, have been working on that on Russia's behalf. Russia also has two sovereign wealth funds, one of which is designated as a precious metals fund. The other one, I think, if I remember correctly, is called a Gokran fund. Sources who I would say I've found to be normally pretty reliable tell me that taken together with Russia's 2,200 tons of official reserves, Russia has probably got a total of about 12,000 tons of gold at its disposal. Now, you mentioned the situation with America. America has 8,133 tons. But the question is it there? The question becomes really a very important one when you bear in mind that Germany had great difficulty getting just a small portion of her gold back from the New York Fed. And this is gold which is earmarked. Now, the
gold-silver ratio is a critical metric for understanding the relative valuation of these two precious metals. As of recent data, this ratio stands at around 77.53. Meaning it takes over 77 ounces of silver to equal the value of 1 ounce of gold. Historically, This ratio has fluctuated widely, but a high ratio often suggests that silver is undervalued relative to gold. Conversely, a low ratio might indicate that gold is undervalued compared to silver. Investors and traders closely monitor the gold/silver ratio as it can provide insights into market sentiment and potential trading opportunities. When the ratio is high, many view it as a signal to buy silver, anticipating that it will catch up with gold, thereby narrowing the ratio. This buying pressure can drive up silver prices significantly. Currently, the elevated ratio indicates a potential undervaluation of silver, which could prompt strategic buying. This dynamic is particularly relevant in the context of Alisdair Macleods' prediction. If investors perceive silver as undervalued and start buying aggressively, it could create a self-fulfilling prophecy pushing prices higher. Market dynamics also play a pivotal role. Silver, unlike gold, has substantial industrial uses, particularly in electronics, solar panels, and various other applications. This industrial demand can add a layer of complexity to silver's price movements. For instance, as global economic activity picks up, industrial demand for silver can increase, driving prices higher. Conversely, in economic downturns, this demand might weaken, potentially putting downward pressure on prices. However, in the current economic climate, several factors suggest strong industrial demand for silver. The ongoing push towards renewable energy sources, especially solar power, where silver is a crucial component, is expected to sustain high demand. Similarly, the growing adoption of electric vehicles, which also rely on silver, can add to this demand. The investor demand for silver is another crucial aspect. Historically, periods of economic uncertainty and market volatility have driven investors towards precious metals as safe haven assets. Given the current geopolitical tensions and economic uncertainties, we are witnessing heightened interest in silver as a store of value. This investor demand, coupled with industrial demand, creates a powerful combination that can drive silver prices upward. Furthermore, silver's lower price point compared to gold makes it more accessible to a broader range of investors. This accessibility can lead to higher volume purchases, amplifying price movements. Retail investors, in particular, might find silver an attractive entry point into the precious metals market, further bolstering demand. Additionally, the physical market dynamics for silver present a unique situation. Unlike gold, which has large, concentrated holdings, silver is widely dispersed. This dispersion can lead to supply bottlenecks, particularly if demand surges suddenly. Any disruptions in the supply chain or mining output can exacerbate these bottlenecks, leading to sharp price increases. In summary, the gold/silver ratio and the broader market dynamics suggest a strong potential for a significant increase in silver prices. The combination of perceived undervaluation, robust industrial demand, rising investor interest, and potential supply constraints all point towards a bullish outlook for silver. As we delve deeper into the geopolitical factors and central bank activities, the case for a rapid surge in silver prices becomes even more compelling. Stay tuned as we explore how these elements converge to support Alisdair Macleods' bold prediction.
And I think that's the best way to look at it. If you're a trader, then you put, your life is in your own hands. Don't ask people like me or you what the hell to do. If you have to ask that sort of question, you shouldn't be playing it. But if you're a stacker, then the answer basically is just keep stacking. If you observe what is going on in terms of the undoubted debt trap that is being sprung on the US government and other governments, incidentally, US government's got what? Something like 125, 130% debt to GDP. That was fine when, we were at the zero bound, but now we have not only got interest rates rising. You look at the yield chart for the 10-year Treasury, and, if you actually bought the yield or were looking to buy the yield, you think, gosh, this is looking very, very good. Yields are going higher. If you're at the Fed, you're sitting there thinking, we want to promise lower interest rates, but we can't do it. And that actually describes pretty well the position which the Fed finds itself in now. And increasingly, market participants are looking at this and beginning to realize that interest rates might not come down. And many of them, or increasing number of them, actually beginning to understand that interest rates have got to rise. Why? It's not because of inflation. Well, inflation, you can see that, month per month per month, the CPI-U has been ticking up from last October. I think I'm right in saying that March was the same as February. But other than that, every successive month has been higher and higher and higher and higher. Forget that, the 1 year moving average. Just look at that, over the last 6 months, what's been happening. So inflation is going up. But the real crisis isn't so much inflation. It is the debt trap that the US government has got itself in. It is then the question as to how high bond yields have got to go for the US government to fund its debt. And there is a further question on that, and that is, the higher these rates go, does it make that debt more attractive to...
Geopolitical factors have historically played a significant role in the valuation of precious metals, and silver is no exception. In times of geopolitical uncertainty, investors flock to safe haven assets like gold and silver to protect their wealth from the turbulence of the markets. The current geopolitical landscape is rife with tensions and conflicts that could drive up the prices of these metals significantly. One of the major geopolitical influences today is the ongoing conflict between Russia and Ukraine. This war has not only disrupted energy supplies in Europe, but has also created a broader sense of instability in global markets. The sanctions imposed on Russia have led to significant economic repercussions, affecting commodities and financial markets worldwide. As tensions escalate, the demand for safe haven assets like silver is likely to increase, driving up prices. Similarly, the strained relations between the United States and China have added another layer of uncertainty. Trade wars, technological disputes, and military posturing in the South China Sea are just a few examples of the ongoing friction between these two economic giants. Any escalation in these tensions could further destabilize markets, prompting investors to seek refuge in precious metals. Another critical factor is the situation in the Middle East. The region has long been a hotspot for geopolitical instability, with ongoing conflicts in Syria, Yemen, and the broader Israeli-Palestinian tensions. Recent developments, such as the resurgence of violence between Israel and Palestinian groups, have further heightened the sense of instability. These conflicts can have a profound impact on global markets, pushing investors towards safe haven assets. Moreover, the broader implications of these geopolitical tensions are not limited to the immediate regions involved. Global supply chains, particularly for key industrial metals like silver, can be significantly disrupted by geopolitical events. For instance, if a major silver-producing country faces political unrest or conflict, it could lead to supply shortages, driving up prices. Investors, anticipating such disruptions, might increase their holdings in silver, contributing to a price surge. The economic policies and reactions to these geopolitical tensions also play a crucial role. For example, central banks around the world might adopt more aggressive monetary policies in response to geopolitical risks, which can affect currency values and inflation rates. In such scenarios, precious metals become more attractive as hedges against currency devaluation and inflation. Additionally, geopolitical events often lead to shifts in government policies and spending. Increased defense budgets, sanctions, and trade barriers can all impact the economic environment, influencing the supply and demand dynamics of various commodities, including silver. For instance, sanctions on major silver producers can limit supply, while increased industrial demand for defense technologies can boost consumption. The psychological impact of geopolitical instability should not be underestimated either. Investor sentiment can drive significant market movements, and in times of uncertainty, fear and caution often dominate. This collective mindset can lead to a rush towards safe haven assets, further amplifying price movements. Given this backdrop, it's clear that current geopolitical tensions are a significant factor contributing to the potential surge in silver prices. As Alisdair Macleods predicts, the convergence of these geopolitical factors with economic policies and market dynamics creates a perfect storm for silver to reach unprecedented heights. In the next steps, we'll examine how central bank activities and the broader economic
basically means held in
support
custody.
This prediction.
It's the central
But
bank
first,
language, if you like.
Let's consider how central banks'
custodial
actions
gold.
are influencing the precious metals market.
The other thing is that we do see every time when Libya fell, for example, when you had the color revolution back in 2014 in Ukraine, allegedly, the first thing that happens is the Black Hawk helicopters come flying in, and guys in, Navy SEALs or whatever they are, nip out, grab all the gold out of the central bank of the nation which has just been destabilized, and they fly off with it. So, why is this appetite for gold? Bear in mind also that a very respected analyst, Frank Veneroso, did some groundbreaking research into central bank gold back in the 1990s. And he stood up at a conference in Lima and said that he concluded that up to somewhere between 10 and 14,000 tons of central bank gold had been leased or swapped, much of it adorning the necks and wrists of Asian women. In other words, the gold had gone and, gone from the central bank system full stop. So what's happened to that? 14,000 tons, the higher estimate, the higher level of his estimates, was precisely half the total 28,000 tons of central bank gold recorded by the IMF at that time. So if up to half of it was out, where was it out from? Was it out from the Bank of England? I don't think so. The Bank of England has been doing a lot of leasing over the years, but the way that tends to work is, and certainly latterly, I mean, I don't know, I can't go back too much, but certainly latterly it's a book entry. You've got the chap, if you like, in the vault saying, this bank has got so many tons, this bank has got so many tons. Okay, this bank is leasing some gold to someone else. Right, it's not leaving the vault, but there's a new entry in the ledger, if you see what I mean. So I think certainly in the last 20 years, this disappearance of gold out of the Bank of England's vaults is probably not an issue. But that leaves America. And I think that this explains why it is that Germany had such difficulty repatriating a small part of her gold. I think it also explains why, allegedly, Black Hawk helicopters are the first to arrive once a government has been toppled. They clean out the central bank's gold. The gold that has been leased, that 14,000 tons, 10 to 14,000 tons, whatever is still out there on lease, has probably predominantly gone out of US hands, if you like. And that would also make sense because it is the US government which has led the way in trashing gold as money and tried to replace.
Central banks have been pivotal players in the precious metals market, especially in recent years. Their actions, both in terms of monetary policy and direct market interventions, have significant implications for silver prices. One of the key factors driving the current bullish outlook for silver is the increasing accumulation of precious metals by central banks around the world. In January 2024 alone, central banks added 39 tons of gold to their reserves, with countries like Turkey and China leading the charge. This trend of accumulating gold has been consistent, reflecting a strategic move by central banks to diversify their reserves away from fiat currencies, particularly the US dollar. The reasons behind this shift are multifaceted, but can be broadly categorized into concerns over currency stability, inflation, and geopolitical risks. Turkey, for example, increased its gold holdings by 12 tons in January, bringing its total to 552 tons, just shy of its all-time high. This move aligns with Turkey's broader strategy to strengthen its financial stability amidst economic challenges and geopolitical tensions. Similarly, China has been on a relentless gold-buying spree, adding 10 tons in January and continuing a 15-month streak of consecutive increases. China's total gold reserves now stand at 2,245 tons, highlighting its ongoing efforts to reduce reliance on the US dollar and shield its economy from global financial volatility. The actions of these central banks are not isolated incidents but part of a broader trend. The Reserve Bank of India, for instance, added nearly 9 tons of gold in January, marking its largest increase since July 2022. The National Bank of Kazakhstan and the Central Bank of Jordan also significantly boosted their gold reserves. This widespread accumulation underscores a growing recognition of the value of precious metals as safe haven assets. But how does this affect silver? While gold is the primary focus of these central bank purchases, the ripple effects extend to silver as well. The accumulation of gold by central banks tightens the supply of available precious metals, increasing their scarcity and value. As gold prices rise due to increased demand from central banks, silver often follows suit due to its strong correlation with gold. Investors looking for more affordable alternatives to gold might turn to silver, driving up its demand and price. Moreover, the rationale behind central banks' preference for gold, concerns over currency devaluation, inflation, and geopolitical risks, applies to silver as well. Silver, like gold, is seen as a hedge against these risks. As central banks continue to buy gold, they indirectly validate the role of precious metals as a store of value, boosting investor confidence in silver. Another critical aspect is the impact of central bank policies on interest rates and inflation. As central banks around the world navigate complex economic landscapes, their monetary policies influence global interest rates. In periods of low or negative real interest rates, the appeal of non-yielding assets like silver increases. Investors seek silver as a hedge against the erosion of purchasing power, particularly in an inflationary environment. Furthermore, the trend of dollarization, where countries seek to reduce their dependence on the US dollar, is gaining momentum. Central banks in emerging markets, such as those in the BRICS nations, Brazil, Russia, India, China, and South Africa, are actively pursuing policies to diversify their reserves. This shift away from the dollar can increase the demand for alternative assets, including silver. The accumulation of gold by central banks also signals a broader strategic shift towards self-reliance and economic resilience. In an increasingly multipolar world, where geopolitical tensions and economic uncertainties are prevalent, countries are bolstering their reserves to safeguard against potential crises. This strategic accumulation can create supply constraints in the precious metals market, further driving up prices. In summary, the actions of central banks are a crucial factor supporting the prediction of a silver surge. The consistent accumulation of gold, the strategic diversification of reserves, and the broader economic policies all point towards a bullish outlook for silver. As we move forward, we'll explore how the interplay of these factors with the dynamics of the gold market and broader economic environment supports Alisdair Macleods' prediction. Stay tuned as we delve deeper into the comparison between silver and gold market dynamics.
Fund, rather like the situation that Volcker sorted out when debt to GDP, incidentally, was something in the order of about 30%. Or is this a situation where higher rates actually make the debt even less attractive? It's beginning to look like the latter. And the more people begin to understand this, the more the flight out of credit will gather. And that flight will go into gold, because gold is the legal form of money. Not only is it the legal form of money, but it has no counterparty risk. You don't want to be in anything where there is counterparty risk. And unfortunately, the consequences for the private sector economy are equally appalling. There has been so much malinvestment. It is the result of suppressed interest rates, suppressed down to the zero bound for a prolonged period of time. And, businesses have been borrowing credit off the banks, funding it, sort of short term. By short term, I mean up to 2 years sort of thing. Not because they were deploying it productively, but because the opportunity to get this, to get credit in order to speculate in something is just too attractive to miss. Now that we've gone from 0 to 5, and it looks like the yield curve will actually go positive, this is a real crisis. I mean, we've seen regional bank failures. That's just the start of it. The real trouble is yet ahead of us. And how we navigate our way through that is at this moment extremely difficult to see. But coming back to the relationship between gold and debt, it is extraordinary. And we have not done this since the 1970s. It is extraordinary to this generation, if you like, of investors to see bond yields rising, the dollar rising, and gold rising all at the same time. And I think I have just told you the message as to why that relationship is.
The dynamics of the gold market offer valuable insights into the potential trajectory of silver prices. Historically, silver has often followed gold's movements, albeit with greater volatility. Understanding the current trends and factors affecting the gold market can shed light on why silver might be poised for a significant surge, as predicted by Alisdair Macleods. Gold has been trading above $2,000 per ounce in early 2024, marking a significant milestone and reflecting strong investor demand. Several factors have contributed to this rise, and they are likely to influence silver in similar ways. One of the primary drivers is geopolitical uncertainty. Ongoing conflicts, such as the war in Ukraine and tensions in the Middle East, have heightened the demand for safe haven assets. Gold, being the traditional safe haven, has naturally benefited, and silver, often seen as the poor man's gold, is expected to follow suit. Another key factor is the weakening of the US dollar. Historically, there is an inverse relationship between the dollar and precious metals. As the dollar weakens, the prices of gold and silver tend to rise. Recent trends indicate a potential weakening of the dollar due to various economic policies and geopolitical pressures. Analysts expect the dollar to lose some of its value, which would enhance the attractiveness of gold and silver as stores of value. Inflation dynamics also play a crucial role. The current global economic environment is characterized by high inflation, which erodes the purchasing power of fiat currencies. In such scenarios, investors flock to assets that can preserve value. Gold has traditionally served this purpose, and silver, with its lower price point, becomes an accessible alternative for many investors. The inflationary pressures are expected to persist, making silver an attractive hedge. Central banks' monetary policies are another significant influence. With rising inflation, central banks might adopt more accommodative policies, such as lowering interest rates or implementing quantitative easing. These measures can devalue fiat currencies and boost the appeal of precious metals. The Federal Reserve's actions, as discussed earlier, have already had significant impacts on market sentiment and precious metals pricing. Similar policies from other central banks can further drive silver prices up. The market psychology surrounding gold and silver also deserves attention. As gold prices rise and capture headlines, retail and institutional investors often look to silver for similar gains. The psychological effect of seeing gold at record highs can spur a speculative rush into silver, especially given its historical correlation with gold. This behavior can create a positive feedback loop, driving silver prices higher. Additionally, the supply-demand dynamics in the gold market can influence silver. Gold supply is relatively fixed, with mining output constrained by geographical and economic factors. As demand for gold increases, supply constraints can push prices higher. Silver, with its significant industrial applications, faces its own supply challenges. The industrial demand for silver, particularly in sectors like electronics and renewable energy, can tighten supply and amplify price movements when investor demand spikes. Furthermore, the role of exchange-traded funds, ETFs, in the precious metals market cannot be ignored. Gold ETF have seen substantial inflows as investors seek exposure to gold without holding physical assets. A similar trend is observed in silver ETF. As more investors pour money into silver ETF, the demand for physical silver increases, which can drive up prices. The interplay between ETF flows and physical demand is a critical factor in understanding potential price movements. To summarize, the dynamics of the gold market provide a strong foundation for understanding why silver might experience a significant surge. The geopolitical uncertainties, weakening dollar, inflationary pressures, central bank policies, market psychology, supply-demand dynamics, and ETF flows all suggest a bullish outlook for silver. As these factors align, they create a conducive environment for silver to follow gold's lead, potentially reaching the $2,000 mark, as predicted by Alisdair Macleods. Next, we'll delve into Alisdair Macleods' specific analysis and predictions to see how he connects these dots to forecast such a dramatic rise in silver prices.
It was easy for China to accumulate substantial quantities of gold without really the rest of the world noticing, particularly with the world's attention taken away from gold, because it was, as far as the Americans were concerned, relegated to the status of a pet rock. So you could see that this was a very good opportunity for the Chinese, who never bought into this sort of fiat Keynesian paradigm, as it were, concept of a fiat currency. They never bought into that at all. But they did understand, they still understand, that gold is money and the rest is credit. I calculated that by 2002, when quite clearly the People's Bank took the view that the state had acquired enough gold. By then, incidentally, I think the official holdings were in the order of 600 tons. I mean, peanuts, really. But clearly, the Chinese government, authorities, and the People's Bank decided that they had accumulated enough of a gold reserve, which was sort of distributed around various accounts, like the People's Liberation Army, the youth wing of the Communist Party, and so on and so forth, not reflected in the People's Bank's reserves. This is the important case, the important point. So by 2002, clearly having the state got its position to its satisfaction, it then opened up the market, the gold and silver market, to the Chinese public. And the Chinese public were actually encouraged by the Chinese authorities to use the newly set up Shanghai Gold Exchange to acquire gold as part of their own wealth. Their television adverts and all the rest of it were this was. But the thing that's interesting about the timing of that was that the timing of these Chinese advertisements telling their citizens to accumulate gold was basically around about the time when we had the great financial crisis developing, which ended up with Lehman, going bust and all the rest of it. So obviously, you could see that the psychology, if you like, of the Chinese leadership, looking at what was going on in the dollar and thinking, hold on a minute, this is not good for our citizens. They were encouraging Chinese citizens to go out and buy gold. So interesting point about the timing of that. Now, I think that by that 2002 date, just looking at those flows, the capital flows in, the export surpluses going out, I reckon that at contemporary prices, the People's Bank could easily have accumulated up to 20,000 tons of gold. And at the
Alisdair Macleods' prediction of silver hitting $2,000 in the next 30 days is based on a meticulous analysis of various market forces and historical patterns. To understand his rationale, we need to delve into the specific arguments and the data supporting them. Macleod points to a unique convergence of factors that he believes will drive silver prices to unprecedented levels. Firstly, he highlights the recent trends in monetary policy. As central banks continue to grapple with inflation, their policies are likely to remain accommodative. This means maintaining low interest rates and possibly engaging in more quantitative easing, which historically leads to higher prices for precious metals. One of Macleod's key arguments is the role of market psychology and speculative behavior. He notes that silver often lags behind gold during initial phases of a bull market, but eventually catches up with even greater momentum. This is partly due to silver's lower price point, making it more accessible to a broader range of investors, including retail investors who might be priced out of the gold market. As gold continues to trade above $2,000, Macleod predicts a spillover effect where investors will start piling into silver, creating a speculative rush that can drive prices up rapidly. Macleod also emphasizes the structural changes in the silver market. Unlike gold, silver has significant industrial applications, accounting for about 50% of its demand. The ongoing technological advancements and the push for green energy solutions have boosted demand for silver. Solar panels, in particular, are a major driver of silver demand. As global initiatives to combat climate change gain momentum, the demand for solar panels, and consequently silver, is expected to rise. This industrial demand creates a strong base that supports higher prices. Another crucial factor in Macleod's analysis is the supply constraints in the silver market. Silver mining production has not kept pace with the increasing demand, leading to tighter supply conditions. The COVID-19 pandemic further exacerbated these issues by disrupting mining operations and supply chains. As the world recovers, the lag in ramping up production to meet the burgeoning demand could lead to significant supply shortages, pushing prices higher. Macleod also points to historical patterns in the silver market. He draws parallels between the current market conditions and those seen during previous major bull runs in silver. For instance, the 1970s saw a dramatic increase in silver prices due to inflationary pressures and economic instability. Similar conditions today, high inflation, economic uncertainty, and geopolitical tensions, create a fertile ground for a major bull run in silver. The technical aspects of the market also support Macleods' prediction. The recent price movements have shown that silver has strong support levels and significant buying interest whenever prices dip. This resilience indicates a bullish market sentiment. Additionally, technical indicators such as the Relative Strength Index, RSI, and moving averages suggest that silver is poised for a breakout. Moreover, Macleod discusses the influence of large institutional investors and hedge funds. As these entities look for opportunities to hedge against inflation and currency devaluation, their entry into the silver market can create substantial buying pressure. This institutional interest can amplify price movements, especially in a relatively smaller market like silver. Macleod's analysis also considers the broader economic environment. The de-dollarization trend, where countries are gradually reducing their dependence on the US dollar, has significant implications for silver. As central banks and sovereign funds diversify their reserves away from dollars, they are likely to increase their holdings in precious metals, including silver. Finally, Macleod argues that the interplay between these factors creates a unique scenario where silver is set for a dramatic price increase. The combination of strong industrial demand, constrained supply, robust investor interest, supportive monetary policies, and favorable technical indicators all point towards a significant upward movement. In conclusion, Alisdair Macleods' prediction of silver reaching $2,000 in the next 30 days is grounded in a comprehensive analysis of market dynamics, historical patterns, and current economic conditions. As these factors align, they create a powerful catalyst that could drive silver prices to unprecedented heights. In the final step, we will synthesize these insights and draw a conclusion on why this explosive growth in silver is not just possible but likely.
Which is one of the things that has certainly contributed to the rise in the value of gold measured in dollars. Now, that speculation, I think, is probably informed by an analysis of actually what the People's Bank is doing. So that speculation, I think, is likely to build up. Now, futures markets don't necessarily lead to demand for physical, but there is a requirement for physical if you get increased open positions in that market. And those open positions will be reflected two ways. Firstly, in terms of the collateral that's required to back those positions. And the second thing, and the collateral really will be in the banking system, as it were. The second thing is that there is probably, through Globex, Chinese involvement dealing on COMEX, which, again, basically means that the swaps on COMEX will find it extremely difficult to close their positions. So the reverberations of what China is doing, the position that China now finds itself in, are going all the way around the world. And despite the fact that retail interest in America and also in Europe is declining on higher prices, prices are still going to rise. As to this recent reaction, I would say that it is perfectly normal. The excessive speculation, perhaps, which is reflected on the Shanghai Futures Exchange, might be behind this move back. There has been a build-up, if you like, in terms of open interest on COMEX as well. Not excessively so, but taking the managed money portion, if you like, or category, to just slightly more than average levels, if you like. Now, that does imply that if you get just a loss of short-term momentum, then these guys are vulnerable to having stops taken out and encouraged to sell on, because there's a correction. And I mean, they're in there, the business of buy dollars, sell gold, or the other way around. Now, they've been screwed by that relationship actually not working because both the dollar has risen and also the gold price has risen. So they must be somewhat confused. But if you are in that position as a hedge fund manager, what do you do under these circumstances? You basically back out until you feel more confident about which way this is going. So I think that probably describes where we are in this consolidation phase after this very sharp run, having broken out of a 2.5 year, nearly 3 year consolidation. Or is it 4 years? Almost 4 year consolidation. I mean, it's a sort of major move on a breakout that you would expect to see. So this pause it doesn't reflect the end of the move. It reflects, if you like, gold is gathering up her skirts before she makes her next move upwards.
Alisdair Macleods' prediction of silver hitting $2,000 in the next 30 days is based on a meticulous analysis of various market forces and historical patterns. To understand his rationale, we need to delve into his specific arguments and the data supporting them. Macleod points to a unique convergence of factors that he believes will drive silver prices to unprecedented levels. Firstly, he highlights the recent trends in monetary policy. As central banks continue to grapple with inflation, their policies are likely to remain accommodative. This means maintaining low interest rates and possibly engaging in more quantitative easing, which historically leads to higher prices for precious metals. One of Macleod's key arguments is the role of market psychology and speculative behavior. He notes that silver often lags behind gold during initial phases of a bull market, but eventually catches up with even greater momentum. This is partly due to silver's lower price point, making it more accessible to a broader range of investors, including retail investors who might be priced out of the gold market. As gold continues to trade above $2,000, Macleod predicts a spillover effect where investors will start piling into silver, creating a speculative rush that can drive prices up rapidly. Macleod also emphasizes the structural changes in the silver market. Unlike gold, silver has significant industrial applications, accounting for about 50% of its demand. The ongoing technological advancements and the push for green energy solutions have boosted demand for silver. Solar panels, in particular, are a major driver of silver demand. As global initiatives to combat climate change gain momentum, the demand for solar panels, and consequently silver, is expected to rise. This industrial demand creates a strong base that supports higher prices. Another crucial factor in Macleod's analysis is the supply constraints in the silver market. Silver mining production has not kept pace with the increasing demand, leading to tighter supply conditions. The COVID-19 pandemic further exacerbated these issues by disrupting mining operations and supply chains. As the world recovers, the lag in ramping up production to meet the burgeoning demand could lead to significant supply shortages, pushing prices higher. Macleod also points to historical patterns in the silver market. He draws parallels between the current market conditions and those seen during previous major bull runs in silver. For instance, the 1970s saw a dramatic increase in silver prices due to inflationary pressures and economic instability. Similar conditions today, high inflation, economic uncertainty, and geopolitical tensions, create a fertile ground for a major bull run in silver. The technical aspects of the market also support Macleod's prediction. The recent price movements have shown that silver has strong support levels and significant buying interest whenever prices dip. This resilience indicates a bullish market sentiment. Additionally, technical indicators such as the Relative Strength Index, RSI, and moving averages suggest that silver is poised for a breakout. Moreover, Macleod discusses the influence of large institutional investors and hedge funds. As these entities look for opportunities to hedge against inflation and currency devaluation, their entry into the silver market can create substantial buying pressure. This institutional interest can amplify price movements, especially in a relatively smaller market like silver. Macleod's analysis also considers the broader economic environment. The de-dollarization trend, where countries are gradually reducing their dependence on the US dollar, has significant implications for silver. As central banks and sovereign funds diversify their reserves away from dollars, they are likely to increase their holdings in precious metals, including silver. Finally, Macleod argues that the interplay between these factors creates a unique scenario where silver is set for a dramatic price increase. The combination of strong industrial demand, constrained supply, robust investor interest, supportive monetary policies, and favorable technical indicators all point towards a significant upward movement. In conclusion, Alisdair Macleod's prediction of silver reaching $2,000 in the next 30 days is grounded in a comprehensive analysis of market dynamics, historical patterns, and current economic conditions. As these factors align, they create a powerful catalyst that could drive silver prices to unprecedented heights. In the final step, we will synthesize these insights and draw a conclusion on why this explosive growth in silver is not just possible but likely.
It looks like a consolidation, but this is different from anything we've seen since the 1970s. And of course, most of the people who see this video won't have experienced the 1970s. Now, what I mean by that is that we have seen bond yields rise, which in recent years, recent decades, has been bad for gold. We've seen the dollar rise on the trade weighted, which has been bad for gold. And taking particularly those two together, you would think that gold actually would have fallen, but instead it rose as bond yields rose, and it also rose as the dollar rose. So this is a very, very different time, I think, from anything we have seen since those 1970s. Now, principally, the difference between that sort of period following the 1970s and the 1970s was until interest rates were raised to close to 20% by Paul Volcker, there was a fear in the markets that hyperinflation would take place. In other words, the purchasing power of the dollar and other currencies would decline substantially in this it was then a new sort of fiat paradigm, if you like. That was finally broken by the determination of Paul Volcker, as I just said, by raising interest rates. Now, since then, interest rates and bond yields have declined and declined and declined. They've now started rising. The problem with rising interest rates now is that it exposes government debt, it exposes malinvestments, it exposes a lot that's going to go wrong in the world of credit. And principally, when it comes to monetary affairs, there are two worlds. There's the world of money, which legally is gold, and there is all the rest, which is credit. So it's that relationship between gold and credit. So what the gold price has been telling us in recent months is that the fear is now about the future of credit, not interest rates, not the exchange rate of the dollar measured in other fiat currencies, which of course is what the trade weighted index is. So this is fundamentally different. Now, to an extent, it has been led by China. The pace of Chinese buying, not just the central bank, but also other Chinese actors of physical gold, has increased. And indeed, we have seen this extraordinary situation whereby Western ETFs have been declining and feeding gold out, as it were, into Asia. Now, this is an extraordinary situation because what that again tells us is that we in the West have tended to sell gold while it has been going into new high ground. Now, this is the sort of behavior which is temporary. Because there does come a point, I'm just purely talking about psychology now, there does come a point where people sort of turn around and say, oh, hold on a minute, gold is in a bull market, bonds are in a bear market, that makes equities less attractive. The only game in town is gold.